Hey there, and welcome back to Crypto Clarified. This is the podcast series where we clarify crypto. We take the most captivating headlines and trends from the crypto space, we break them down and explain what's going on to help you understand what is a fast-moving and complex space. My name is Benjamin Dean, and I'm Director in WisdomTree's Digital Assets team. Today, I've got the pleasure of being joined by Erin Friez, co-founder and CEO of Digital Asset Research. Today's show, we're going to talk data. Good data, bad data, why it matters, because as we've seen over the last decade, good data matters and bad data is a big problem. We're going to talk about some of the pitfalls people have fallen into in the past and how those have been fixed over time. And then, as always, we'll finish up thinking about the future. It's the end of the year, folks. End of the year. So it's a big 2024 coming up, and we'll think a little bit about what to expect as we go down the pike. Before we start, US listeners, check out wisdomtreeprime.com, Apple, Android app stores, wherever you get apps. Find purveyors of apps. That's where you can find the app. Hit subscribe and share on Spotify, YouTube, iTunes. Again, find purveyors of podcasts. Wherever you want to get podcasts, hit subscribe, make your life easier, and you'll get this every time we release a new episode. You can find me on the Bird app at Benjamin Dean. Before we begin, Sam and James, you know I love this part. Strap yourselves in, people. It's compliance disclaimer time. Before I begin, I need to state the following to clarify the views and opinions expressed in this podcast are those of WisdomTree and Digital Assets Research and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, solicitation to buy or sell any securities. Relies upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. All right, on to the fun stuff. Erin, it's always lovely to see you. Welcome to the podcast.
Thanks so much. Yeah, great to see you as well.
We've known each other for a few years, and you've got an interesting background and journey you've taken throughout the space. How about you run through the listeners a little bit about how you got involved and what you're doing now?
Yeah, absolutely. Yeah, we have known each other for a couple of years. So I actually came into the crypto space. I'm an attorney by trade. And so I came in as a pretty staunch crypto skeptic, to be honest. I first learned about crypto back in 2011, 2012. And my first response was, I don't know why anybody's paying attention to this from a regulatory standpoint. There's no way this will work. And I, the regulatory red flags seemed far too great to me from the very beginning. When I first, I'm an attorney. I spent many years doing corporate work for tech and fintech companies. And so I started to get questions around crypto probably around 2017. And back in those days, it was early enough in the legal space, especially, that once you answered one question around crypto or had one client that was in the crypto space, you got them all because no one really had any experience in this space. And so fast forward a couple of years, and that's really all I was doing was work in the crypto space, and it's really consumed my professional life for the last 6 years now. And happy to be here. I can say I've changed my tune a little bit. I started working with Digital Asset Research.
I said that's good. Welcome. It's always nice to have more lawyers. We love lawyers in the crypto space.
No one ever says that, so thank you. I appreciate that. I started working with Digital Asset Research in around 2018. We were at that time primarily a research firm, so you could think about the equivalent of sell-side research. In the traditional space, that's what we were doing. We were formed in 2017, which was right around the ICO boom. So there were a lot of new assets. There were a lot of new firms entering the space for the first time, and they needed to know the basics, right? What is this asset class? How does it trade? How does it custody? What are the risks? What are the valuation metrics? How do you think about it? And so we were doing long form research on these assets. One of the things we ran into from the beginning was, where do you get the data from? Because research is really only as good as the data you're putting into it. And none of the solutions in the market at the time we thought were satisfactory. Crypto, especially at that time, exchanges would pop up overnight with with billions of dollars in trades that they were reporting that were clearly not accurate. And we didn't want to be, accept all of that data into our research. Data in, data out is garbage in and garbage out. And so we
Gaga.
started to really ask hard questions around which exchanges and which data sources can you really are more trustworthy. What does price quality look like in this space? What do real volumes look like in this space? Can we identify fake volume? Can we identify signs of manipulation? And what's important when you're having those conversations? And so we started to develop that methodology. And I came to it from, a legal background. And so, risk and compliance was really sort of the top of the list of things that we were thinking about when we started to, develop our own methodology when we think about price and quality. So we started working really early on with FTSE Russell and the London Stock Exchange Group. And when we first started working with them back in 2018, we actually started with the risk and compliance team. That's where their crypto journey started, which I think is a really interesting place for our crypto journey to start for a large institution. But it was really helpful because we were able to, answer the hard questions right up front and get to a methodology that they could get comfortable with. Um, as an index provider, having a quality price was the first and most important question that FTSE had to answer. And so, we spent a couple of years developing, this methodology and how do you identify price manipulation in the market. And it's really shaped the journey for DAR since then.
So, how do you identify price manipulation and wash trading and things? Because we know they're distributed ledgers, but then a lot of the trading happens in centralized exchanges, which aren't on the distributed ledger. And I mean, from back in my days of doing like traffic analysis, like you can pick out anomalous patterns, but these are quite specific. It's like fraud detection, really. What are the kind of things that you folks look at that hint to you that something is awry?
Yeah, it's a great question. So, and there's a couple of different ways that we do this, and at a couple of different levels. So we look at both qualitative and quantitative upfront. So when we're looking at, all of the pricing sources that could go into a price for these assets, right? There's a lot of them. There's centralized exchanges. There's decentralized exchanges. There's peer-to-peer trading right on the blockchain. There's over-the-counter desks. There's a lot of different ways that these assets are traded. It's a unique problem because when you're thinking about in the TradFi world, there's a primary listing market, and so it's a lot easier to understand where the price is coming from, because these trade globally on hundreds of, if not thousands of venues. You really have to think about how do you evaluate those. We're looking for when we're trying to get to a good price. There's sort of two different things we're thinking about. One is qualitatively, you know. Thinking of like counterparty risk, right? Organizationally, is the exchange doing the things we would expect to see from a mature traditional financial institution? Things like the protection of client assets and the separation of duties between a custodian and the trading venue. Good governance, independent oversight through an audit or through a board, those types of things. Are there policies and procedures in place that we would expect to see around financial crimes, know your customer, anti-money laundering, those types of things? Do you know who's interacting on your exchange? Really a first line of defense when it comes to, identifying um, uh, manipulation. And we've seen those stories, on that side of the methodology. We've seen those stories play out in the news for years in the crypto market, right? If you don't know who's interacting on your exchange, the likelihood for wash trading, obviously goes up materially. I remember a couple of years ago there was a story of a college kid that was hired by many crypto projects just to wash trade assets on exchanges, and he would open up many accounts and just trade back and forth with himself all day, and was paid, to do that to pump volume for specific assets. Um, so we want to make sure that they know who's interacting on their exchange. They have market surveillance software in place and they're using it, right? That they're identifying these these behaviors, and taking action accordingly. So that's on the qualitative side, on the counterparty diligence side. We also look at price quality though. So what is the data that we actually see coming out of these venues? So we're looking at order book data and trade data, putting it through a series of tests, to make sure that it's what we would expect to see from a market. And I can give you several examples of what this might look like. So uh, for example, when we're talking about just fake data, right? Where we're talking about these exchanges that pop up reporting billions of volume, in trade volume overnight. One of the things that we see is that the distribution between buys and sells looks not like what we would expect to see from real volume. So most exchanges will label all of their trades as either a buy or a sell. That will come through in the data that we receive from the exchanges. Um, what you would expect to see in a typical market is that it's more favorable to buyers or more favorable to sellers, depending on the conditions at any given time, right? You're going to see more sells in a row or more buys in a row, depending on what's happening in the market. Um, what we don't expect to see is a completely randomized distribution of buys and sells, right? A buy, a sell, two buys, two sells. When you look at the distribution of that data, if it looks like it's all randomized, um, that's not what we would expect to see in an actual market. Crypto markets are volatile, and there's sometimes you can't predict what's going to happen, but they're not random. They don't look the same as a coin toss. There is there are market ebbs and flows that we see. We expect to see more buys in a row or more sells in a row given at any given time. So that's one of the things that we can look at to see, does this data look like what we would expect it to see? And there's a lot of different versions of that. We look at the order book. Are the spreads what we would expect to see? Obviously, we expect to see lower spreads, smaller spreads for more liquid assets. We look at trade lot sizes. So, we don't expect to see the average trade lot for Bitcoin be 6, 7, 8, 9, Bitcoin at a time, even for the institutional exchanges, the exchanges that interact mostly with institutional clients. Trade lot sizes are typically a tenth of a Bitcoin, half of a Bitcoin or smaller. We're not seeing. Obviously, we do see the larger trades, but that's not going to be the bulk of the trading. They're still going to happen at smaller lot sizes. So when we see an exchange say that their most typical lot size is 9 Bitcoin at a time, that's a big red flag for us. And there's other things like that. How what is the depth of the order book, right? Like, what does the slippage look like when there are large, a lot of trading happening at once? um uh, trading patterns, prices, is the price correlated, across other markets that we see? Is the price in line? Does it deviate frequently? When there are large spikes in volume, does the price deviate? We're looking at all of that type of data to see, are there red flags that we can identify from this exchange? And so we actually look at this on a quarterly basis, and it changes frequently. And the number of exchanges that we're looking at changes frequently. I would say on a month to month basis, there are at least 10 to 15 exchanges that fall out of the universe completely, that they no longer exist, and 10 to 15 new ones that come in, which might not seem like a lot, but when you're talking about 5, 6, 700 exchanges, that many coming in and out every month, actually is a pretty big percentage. So we see new exchanges pop up all the time. And so we look at both qualitative and quantitative. We want to make sure that the data we're seeing makes sense. It's what we would expect to see. We want to make sure that the their policies, their practices, that's what we would expect to see from an organizational standpoint. We put those two together to determine what we think is, the more trustworthy pocket of the market, where we think the data is is high enough quality to be included in our price and in our volume figures. We take all of that data, we aggregate it, and that's how we get our pricing data. volume data is a whole separate sort of conversation. When we're talking about volume, again, because these assets trade across a really large number of trading venues, it's hard to pinpoint it, or if not impossible to pinpoint exactly what the volume is for these assets. And some of those trading venues are really opaque. OTC desks, a lot of trading happens on OTC desks. That volume number is really going to be hard to pin down. Um, so what we look at is what do we know is at least the floor for volume, right? It's much smaller than all of the hundreds of exchanges out there put together, because we don't include all of those exchanges for the reasons we just talked about. We don't include all of those in our volume numbers. We look at the exchanges that do pass a minimum number of these tests to say the volume coming from this exchange should be included in a market volume, and come up with what we call verifiable volume. So that's a minimum amount of volume that we think is trustworthy in the market, knowing that there's some space above that we're not able to capture.
Okay. Wow, that really is a lot of information.
Yes, it is, and we do that on a quarterly basis. So there's a lot of work that goes into what is the price of Bitcoin. It's quite a long answer.
I mean, a lot of that is basic due diligence. Are these people
Mm-hmm.
running the shop correctly? A lot of it's pattern matching
Exactly.
and recognition.
Mm-hmm.
I imagine with the decentralized exchanges, you just basically like do network graphs, and you'll find which wallets are trading with one another pretty quick, right? So taking all of that together, then FTX. What was your view on FTX, and how soon before it blew up did you see the red flags?
So FTX actually never passed our vetting. So it was never part of our pricing uh, data set. We saw the red flags really from the beginning. I can't say that we knew all of the red flags. There were certainly some things going on that we did not know about and did not catch, and we learned some lessons there of things that we need to be more to be asking better questions, especially around the safeguarding of client assets and the separation of custody versus exchange and those types of things. We definitely learned some lessons there. Um, we didn't include FTX in our pricing, though from the beginning. There were a couple things that we saw that didn't meet our standards. Their financial crimes policies from the beginning were not what we wanted to see from exchanges, and the transparency level, to be honest, was not there with us. We obviously we come asking questions to these exchanges, and they weren't willing to be forthcoming with the answers. And so we took that as that it could be a red flag, could just be that they didn't want to participate. But we didn't include them from the beginning. We were our clients that rely on our exchange vetting methodology to understand counterparty risk and to make those sorts of decisions, we're actually able to manage the risk in that, and we're not highly affected um, by the blow up there.
Good. How about Binance?
Yeah, it's another good one. Binance has changed over the years for us.
True.
So Binance at first it did not pass our vetting it by any measure at all. Um, Over the last couple of years, Binance has started to pass onto what we call our watch list. So we have different tiers of exchanges. So we have exchanges that pass everything that we have really solid license agreements in place with. We call those our vetted exchanges. They're our top tier. Then we have another subsection called our watch list, and these are exchanges that pass all of the criteria that we deem critical, right? To know that the price quality is something that we trust, but they don't quite pass all of the standards, right? They don't have the policies in place that we want to see from a mature organization. There are some, regulatory issues, perhaps, those types of things. Or they don't pass all of our data science tests. There's a lot of reasons why somebody would end up on a watch list instead of a vetted list. Binance has been on our watch list for a while. They're a large obviously the largest contributor to volume. So, to not include them in our vetted list and in our highest quality prices, there's a big hit of volume happening there. We do make sure that the price is not affected by that. That it's still well correlated, and especially with more liquid assets, the price is well correlated across all of these markets, which is good. So we can exclude an exchange like Binance without affecting the price. But when it comes to Binance, one of the things that we've actually seen them improve on over the years it is their financial crimes policies. So there was a point in time where you could go to Binance, you could trade with just an email address. Obviously, that didn't meet any standards when it came to quality. They've improved that over time, so they actually have uh, passed more and more of our standards as the years have gone on. There's obviously been some regulatory issues that they have not addressed that we've been seeing play out recently, which is really why they've never truly been on our vetted list is because those regulatory issues have always sort of been hanging out there. Um, I will say that Binance US was on our vetted list. They no longer are because we saw when the SEC lawsuit came out, their price actually diverged from the market. So we had to remove them because we saw a price quality issue. Their prices were pretty far off market from what we were seeing elsewhere. We were able to, in as that lawsuit moves forward and we all learn more, and I think we're learning more from the Binance situation overall. We'll see, how that shakes out. But we, had a lot of conversations with the folks that started Binance US, to get comfortable, with their policies and their practices, and they actually were pretty transparent with us and forthcoming. They've now been removed, obviously, for price quality issues. But yeah, it's the one of the things that we knew we needed to do from the beginning of this is have a methodology that allows for this type of thing to happen, right? That allows for exchanges to come into the pricing, allows for exchanges to fall out of the pricing for these reasons. As we see exchanges mature, we want to see them, be included if they can. As new information comes out, we knew exchanges would have to be pulled out of the pricing source. We do still expect a lot of M&A to happen in the space. I think as it matures, we'll see that across the exchange space. I think we'll see it consolidate and tighten. So we wanted a methodology that was really flexible, instead of saying it's these 4 exchanges or it's these 5 exchanges. In our pricing source, we change it every quarter according to what's actually going on in the market. And quarterly does seem like a lot of a lot of work, to change that list 4 times a year. But as you know, I'm sure crypto markets move fast, and things. One year, I heard somebody say that you should measure crypto time in dog years. So 1 year is like 7.
So what's the delta on kind of the ones that pass the green checkbox and the ones that don't? And by that I mean, if we take the whole universe, pull in the data, and you can look at price or volume, and then you take this subset that have got the green light or the green checkbox, like how big a difference is it? And I know that it will be different over time and it'll be different across different assets and things like that, but how material is it?
Yeah. So 2 answers to that, I think. So the first, in terms of, what is the real difference? It can be a really material. So we've seen price differences, if you include the whole universe, hundreds of exchanges, versus what we think is, price quality exchanges, be as high as 20% for some really less liquid assets. When you get to the more liquid assets, for Bitcoin, we've seen the price be as much as 1% off, which, if you're striking a NAV, 1% can be a pretty big difference. So in terms of the actual price difference, it can be a lot, depending on the asset. But the other thing that I would say about that is that it makes a really big difference, I think, when we're talking about the market as a whole and how it's viewed, especially from a regulatory aspect. I know one of the things, a lot of people are watching the ETF space right now and these filings that have been coming up. When years ago, again, just a couple of years ago, but the last time we went through this with the SEC and we had, ETF filings and we saw those denials come out, the number one thing that we saw the SEC say over and over and over again, the main theme of those denials was price quality and price discovery. And is this a price that we can trust? And how do we know that the market isn't being manipulated? Um, One of the arguments that we heard made repeatedly in the previous applications was, well, we all know that there's this segment of the market that is not good, right? That's not regulated, that's operating either nefariously or just is not mature, has a bad price, has bad practices, but that's over here in the corner. But we also know there's a an orderly market, right? There's a market that we do trust, and that's over here, and this is where we're getting our price from. Like, this is the market that we don't think is being manipulated, and we should just focus on this. um, and what the SEC came back and said was, that's all well and fine. Like, if we just accept, your version of these exchanges are the ones where there's real volume and real market activity, and they operate in an orderly fashion, we can trust that the price coming out of that. That doesn't mean we can ignore everything else that's happening, because what happens if the price of Bitcoin moves materially? Where did that originate from? What if it originates over here in the bad market, right? Even if we all agree that this is fake data, this is bad data, it's not high quality, it shouldn't be included. If the price of Bitcoin on one of those exchanges rises by, a couple of percentage points, does the rest of the market follow suit? Does this nice orderly market that we're looking at respond to that? Or, when we see these movements in the price of Bitcoin, where is it leading? Like, who's leading those movements? Is it the orderly market we trust, or is it the bad market that we don't trust? That was one of the biggest questions that they wanted to have resolved. We actually spent a lot of time looking at that question, and we talked to the SEC several times around what we found there. We did find that in most cases, when the price of Bitcoin was moving materially more than, I believe we looked at 5%, it was that price movement was originating out of either a vetted or a watch list exchange, exchange where we could trust the data. Not always, but most of the time. But it's a really interesting question. I think that it's it's one thing to know that your price and your volume figures are high quality. It doesn't, I think we, as a market, as people in the crypto space, I still think there's a lot of work to do to clean up the rest of the market, so that from a regulatory point of view, the data coming out of it is more trustworthy.
It's probably an issue as well where I don't trust this exchange, and yet there are people on the exchange doing legitimate trades, which,
Yes.
in a way, if you chuck it all out and you say, nah, well, it doesn't matter. But if people are doing sizable trades that are real trades on venues that you kind of said, no, we don't like them, then you miss that as well, right? And I guess you'll see it, as you're saying, like flow through into the ones that you do keep an eye on and are green lighted. But then there's the turtles all the way down problem, which is markets are convexive. What's the old Warren Buffett quote? No, it's not Buffett. The convexity of markets, which is one thing influences another, which flows into another, which loops back, and basically reflexive. I'm sorry. It's obviously getting very late in the year. They're reflexive. And so trying to sort that out, I imagine, also is one of those things that requires a lot of thinking, a lot of work, but it's just kind of inescapable, isn't it? And it was Soros that said
Yeah.
that.
We got there in the end.
That is the end of the year.
It is. Exactly. Yeah, you're right. Because we are excluding some exchanges, there is some real volume that we know we're taking out of our price and volume figures. But the problem is that you can't, if we don't trust all of the data coming from an exchange, you know, there's no way to know what's real and what's not. So we would rather be confident that what we do include is from trusted exchanges as opposed to including some that's not.
Yeah.
And we have seen the markets mature over time. The list of exchanges that we include has grown. The list of watch list exchanges that we include has grown. And we talk to these exchanges a lot, right? And we've seen them mature over time. We've had conversations with exchanges that in the beginning didn't want to give us their historical data because they weren't super confident in it. And now we've seen them mature and become more forthcoming. So it, it the markets are changing. There are more regulations, I think, that are globally, that are thoughtful. Might not be perfect, but I think are really helpful in moving us forward. I am a big proponent that regulation, if it's done correctly, really could be a big driver here. I think it's obviously had a big impact in the U.S. and how and with crypto markets here, I think it's going to continue to do that. But I do think that there are institutions. I think there are whole swaths of the financial space that have not adopted crypto in a large way that could make a big difference, and that's not really going to happen in a meaningful way until the regulators are comfortable with these topics. Exactly. When we think about the wealth space, the RIA space, I think it's a space that people have been trying to unlock in crypto for years. And it's hard to do, right? Because you need regulation and you need high quality prices, and we're getting there. And there's a lot of really good work being done, which is great. But I think continuing to really examine the market and these exchanges and what's going on, and continuing to advocate for sensible regulations is the path forward.
Cool. The place is changing. It's professionalizing. It's all part of the adoption curve, really. It's a totally
Yeah.
different world to 5 or 10 years ago. And yeah, cleaning up that kind of stuff is part of the natural selection process, but also, as you say, you can do it top down as well. Look, we're coming up on time though. Um, we're at the end of the year 2023. It's been a busy year, lots of happenings. Looking forward, what have you got your eye on for the coming year, 2024?
Yeah, it has been a busy year. And it's hard in crypto because there's always about a million things happening at once, and a million more coming down the pike. I learned very early on in crypto that if you try to keep track of all of the things, you will fail miserably.
Yeah.
So um, I think for us, I think really for everybody, I'm sure you've heard this answer a lot. The regulatory landscape in the U.S., I think we've got to keep our eye on, both from the SEC perspective. I think with the ETFs, everything that's happening with the Ripple case, all of the exchange lawsuits that are out there now. Kraken, I think, is the latest one. I think seeing how those play out really will make a big difference in the market overall. And then even outside of the SEC with Congress, we've got a presidential election coming up. All of those things are going to make a really big difference um, in the crypto space over the next year. I also think there's a lot of really positive market signals. There's a much more reasons to be excited about the next year sitting here in December of 23 than there was in December of 22. We've got the possibility of the ETFs coming up. There's a Bitcoin halving that's coming up. There's a lot of great price movement that we've seen over the last couple of months that we hope that continues. So I think there's a lot of really positive market signals that we can be excited about. I'm certainly more excited than for 24 than I was for 23. And then we're really keeping an eye closely on the tokenization space. I think that as the next crypto bull run really takes shape, tokenization is going to be a bigger and bigger part of that conversation, which I think is exciting because it really unlocks a whole new, market cap in a really material way. Like when you look at the market cap of crypto, it's tiny compared to anything in TradFi. I mean, we're still a very small segment of the market. When you start tokenizing the rest of the markets, even in some small percentage, that's going to become more and more exciting. It's going to drive that up, which we're excited about.
I'm glad you're excited because I have a lot of work to do in 2024, especially around tokenization.
Yes. Great.
But
Love to hear that.
Erin, where can people find you on the interwebs?
Yeah, you can find me on LinkedIn, or you can find me at digitalassetresearch.com.
There you go, folks. Another big year. It's nice to close it out with you, Erin. With that, though, we are out of time. I hope everyone's found today's podcast useful and informative. US listeners, wisdomtreeprime.com. Check it out. You can find me at Benjamin Dean on the Bird app. Thank you very much. Have a happy holidays, and we hope you all have an excellent day.